and you got about 0.17% gain as well. 60,223 or so on the mid-cap index is what you have. 1,100 stocks are higher, about 600 stocks are lower, and that's a market open. Nifty 50 heat map gives you a quick sense of where things are landing, right at the word go, in the green zone or the red zone, mostly in the green zone. So BEL, Infosys, Mahindra on one side, Bajaj Finance, Bajaj Finserv on the other end of the spectrum. But bulk of what is starting in the green right now. The Nifty's accumulated about 40 points. This is, of course, the first 90 seconds of market open. Let's talk about stocks. Survey.
Okay, and then on stocks, we have to talk about Bajaj Finance. And if you're wondering what happened, what went so wrong, 6% down on the stock. Well, two things. Slight reduction in their AUM growth guidance. They've reduced it by 2 percentage points. That's one. But the other thing which the market has not seen across any lender this season, I mean, any large lender or mid-sized lender, is asset quality stress. And in Bajaj Finance's case, the gross NPA levels have moved up from around 1 odd to, I think, 1.2. We'll get the exact numbers once again with Gaurav in just a bit. The company has explained that this is because of a new method of calculation of NPA. But whatever it is, the markets are nervous about it right now. In fact, even Bajaj Finserv has fallen after that, 3.5% down on Bajaj Finserv as well. Britannia is the other casualty of the morning. 5% down. Clearly, the market's sort of uneasy about the manner in which Mr. Berry has left, literally gone in a day after a legacy of so many years. So that's weighing on Britannia. So those are the two big newsmakers of the morning. Now, let's see what else is happening on the Nifty. Since we're talking about the losers, Tata Motors, Tata Steel, these are some of the other stocks that have a little bit of red. Otherwise, the Nifty is fine. I mean, beyond these 3-4 big newsmaker names, there's not too much on the downside. On the upside, BEL 1% higher, Max Healthcare 1%. Some buying on M&M, some buying continuing on IT from yesterday, by the way. HCL Tech, TCS, Infosys, between 0.5% to about 1% on these stocks. So IT is still a bit of a support, as is Reliance and ITC, the big boys. Reliance is up 0.5%, ditto for ITC. But overall, all things put together, Nifty is very, very uneasy. It's just about 9 points up, and the Bank Nifty is now already slipping into negative territory. So beyond the Bajaj twins, keep an eye out on names like SBI and Kotak Mahindra Bank. All have a tinge of red on them. Nigel.
Well, a few stocks actually from the broader markets are calling for attention. Vikran Engineering, the numbers look quite good. Vivek had told us about that. That stock, in fact, is up and about. KEC, they are saying that they're sure that the second half of the year is going to be much better and the margins will improve, which have to come at the upper end for it to achieve that 8% that they're talking about. So that's another stock that's trading in the green, come off the top. Syrma was up close to around 2%. I think that as well has come off a little bit. Bazaar Style Retail, that's another stock. Syrma still holding with a 3% gain. Bazaar Style Retail, one of the top volume movers. It's moved into the red. It was up 3% just a few minutes ago. HEG continues to hold on to gains. Basically, it's it's the stock that's pulling back yesterday's losses. Was down 6% yesterday, pulling back 3% today. On the flip side, HLE Glasscoat, that stock is down more than 10%. The street clearly doesn't like those numbers. Stock getting slammed as we speak. You have Subros, that's another one that's getting hit in today's trading session. I think they had their call as well yesterday. Not Subex, Subros should come up for you. That stock, in fact, is down 5.5%. And transformers and rectifiers, for the second day, well, that stock is getting a bit of a knock. So fair bit of reactions, both on the positive and the negative terrain. Transformer and rectifiers now down close to around 10% as we speak. Sharp knock. And Ola Electric had that one-way move from 40 to 70. Guess what? It's at 43 yet again. So that one, in fact, has come in for some solid selling pressure. Translated Lighting, I think we were talking about it yesterday. It was weak, but that stock is popped up today. It's up close to around 4% or thereabouts.
Okay, more stocks as we go along, but you've got what? Markets now blinking red and green. The initial pop on the 40-50 point gain on the Nifty has been given back. We're at about 550 or so. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Thanks for joining us. Any thoughts on Bihar, Ashwini?
Morning, Prashant. Not really. It's too close to call. Voter turnout's been extremely high, and that usually is a signal that many voters want change. But it's going to be a very close call, so I don't want to really take a pot shot at that.
Will it matter?
I don't think so.
You don't think so? Okay.
So,
and why not, Ashwini?
Okay. So the fact is that the economic policy has separated itself from politics, by and large. If you look at what's happened over the last 2 years, despite the kind of narrow margin of victory in the central elections, the government's continued to press ahead where it can. And I say where it can because some of the harder calls that need to be taken by India, and I don't mean any political party, but by India, can't be touched, such as administrative reform. States make a huge difference. I think, the politics of the day also believes in giving away a lot of goodies, which I don't really like as a market watcher. And as an economics enthusiast, but that's the way politics has evolved in this country, and every party seems to be doing it. So I don't really see the Bihar elections making a turn in the economic policy of this government. So that's why it doesn't matter.
Fair enough. I'm just going back to Bajaj Finance and seeing the stock reaction now. 7% down on Bajaj Finance. Now, what has gone so wrong? I mean, actually not much. If you try and look at it, from a slight distance, the NPA has moved from about 1 to 1.2. The credit cost has gone up 3 basis points. But look at the stock now. Now look at the one-year trajectory, and that's the issue. Bajaj Finance has rallied well over 40% this year, in a year where the market otherwise has been so range-bound. Let's put up a one-year chart on Bajaj Finance there. 50% rise in 12 months. Now, after a 50% rise, always, that fear of heights and profit-taking at the smallest hint, perhaps. So comment on this, Ashwini. Hi, great to be speaking with you. I'm now pivoting back to earnings because I guess that's all we can really track, right? We don't know what's going on with the US president and the deal, or politics, as you're saying, is beyond us. Now, on earnings, why I want to pick up Bajaj Finance as a case study is that sentiment still seems to be so nervous and jittery at the slightest hint of something going wrong in numbers. So, your sense on these large NBFCs, and then, what does it tell us about the market mood and psyche overall?
So, Ruby, I think you've picked the point that I've been scratching my head about over the last few days. There have been several stocks where earnings have either narrowly missed estimates or actually have been in line with estimates, and the stocks have got sold off, and the punishment being meted out is quite severe. In the mid-cap, small-cap space, there are several stocks which are down like 15, 20% on numbers which, to one's eye look reasonable, and, reasonable growth on a year-to-year basis, a reasonable, performance in what can be termed as reasonably challenging environment, and the stocks have got sold off. So I think what's happening is that the market's underlying tone is slightly nervous. We are not seeing any significant support from foreign investors. The amount of paper flow continues to be very high. New listings are not providing the kind of leg up that investors are hoping for. And in this environment, the single biggest question on the investor's mind is, where can I take profits off the table, or where can I take money off the table? And that's what's happening. My sense is that people are also very unclear about the demand outlook for the next 6 months. So while, many of us are hoping that the cut in GST rates will propel demand, not just for the festival season, as we have seen, but for the longer term, there are some question marks around rural demand recovery, with extended rains having hurt crops. There are some concerns that post the festival rush, demand may slow down again. And people are worried about all of this. So, this is what is showing up. Specifically on NBFCs, while the commentary is positive about the direction of credit costs, Q2 continued to be challenging on many fronts for several lenders. Some of it is basically the tail of the MFI credit costs still feeding through to the system. And in some cases, it's new stress emerging on MSE. The amount of stress is small, and it shouldn't merit the kind of punishment some of these stocks are being meted out. But it, again, is a function of how demand revives over the next 6 months. If demand is indeed weak, and this festival rush was just that, a festival rush, then we have a problem.
All right. Hi, Ashwini. Good to see you in. One of the points you mentioned was this fresh supply of paper, right? What do you make of the recent IPOs? Lenskart, everyone was looking at it through a lens. To be fair, it's had a pretty decent listing, though the float is very, very limited. As of now, like we see in most of the IPOs. Stock was down yesterday 10%. Today, it's one of the top volume movers. And the last I checked, it was still in the green. Any view on this name?
I wouldn't want to comment on the name, but I find a lot of the new IPOs quite expensive. They don't really leave a lot of upside on the table from the near-term perspective. It reminds me a lot about the IPO rush that we saw in the third calendar quarter of 2021. And frankly, I've stayed away from most of these IPOs, or pretty much all of them, and I don't see any value in them whatsoever. So that's the real issue. These IPOs are being priced to perfection. And when investors don't make money in IPOs, it slowly sours the mood. So in a way, it's actually positive for secondary markets because, if the IPO flow slows down, that's actually a positive for secondary markets.
Lost up to 200 plus and then fell to about 130, 140. It's coming up about 5%. So there's a bit of a recovery afoot as far as urban company goes. Thangamile, of course, it's just a rocket, absolute rocket in Thangamile. From 2,000 to 3,000 in, I guess, 10 days? Thangamile, right? So that's something. Craftsman Auto, another one of those steady compounders, 2.5% higher. MTAR Tech had a bit of a wobble. It's back up about 3.5%. So lots happening. Although I must point out that just purely numerically, more stocks are down than up. About 1,400, 1,450 stocks are lower. And you've got about 1,100 stocks which are higher right now at this stage. MapMy India is down about 5.5% as well. There is stuff moving around. HBL, which was up 12% yesterday, just some profit booking, nothing more, 3% lower. It's got volumes as well. HLE Glasscoat, I think Nigel mentioned it, 13, yes. 14% lower on decent-sized volumes as well. So that's the picture. Ashwini, we'll leave it there. Thank you very much for joining us. A pleasure having you here on CNBC-TV18. Thank you very much. 45 points lower on the Nifty. Surabhi.
Okay, well, with that, let's pivot back to corporate conversations then. And the company that we're looking at next is HUDCO. Reported a pretty steady set of numbers for the second quarter. Net interest income is up a little over 17%. And the company continues to show, a solid margin trajectory for the first half as well. The cost of funds has been coming down. We have with us Mr. Sanjay Kulshrestha, Chairman and Managing Director at HUDCO. Mr. Kulshrestha, thank you very much for joining in. Looks like another, pretty steady quarter for you. And you've already given us that guidance. You've said that as your book keeps shifting more and more to urban infra, your margins will improve. I think for the first half, you're just under 3% net interest margin. And what you told us earlier was that by the end of the year, you will get to about 3.3%. So is that trajectory on track?
Yeah, very well. I think we are on the track and it's a half-yearly result. And you also understand there are so many businesses that we are doing and a lot of business potential is there in the urban investment. And I'm pretty sure that we will be maintaining the figure of 3.3 in the NIMS, net interest margins. And at the same time, we will keep the business ongoing in the same rate.
Okay. All right. Hi, Mr. Kulshrestha. And
Hi. Good morning.
Good to have you on the show. So we got the point out on NIMS. What about growth? You'll have to revise the estimates, right? Because going by the half-year number, it's looking spectacular. So give us the fresh guidance, both on disbursements as
that we had given of 1.5 lakh crores by FY26. So we had revisited and the initial figures we are targeting is 1.6 lakh crores by FY26. But we had not worked out for FY 2030. We are maintaining it as 3 lakh crores as well.
Okay, got it. So that's the numbers out of the way, both on the growth of the loan book and the margin. It's looking really, really solid this year. Now, give us a little bit of qualitative color on this. For the rest of the year and going into next year, which are the urban infra projects that are going to drive this growth? And I just want to understand which of the projects are most profitable for you from a margin perspective as well. So which ones will you bid for more aggressively?
I think if we see the greenfield projects, they are more profitable. If I compare with the refinancing kind of projects, the road sector is giving quite a fairly good kind of spreads and the NIMs for the books. We are only compromising on the social sector, that is the housing, that too for the affordable housing. And this is coming out as a counter requirement of the state governments. Presently, they are not coming up to take these kind of loans, and they are managing themselves. So I didn't look that we will be compromising on our names, but all greenfield sectors, and I think they are very promising, and we will be maintaining our spreads on these kind of sectors.
So yields are highest, you're saying, on the road infra side?
Yeah. On the surface infra side, if you see, there are good projects which are lined up, and these are huge capital which has to be infused, and there is a proper planning also. And now we had also started this private sector lending in 5 sectors, including road, port, airport, which is all mobility related. Others are the energy or power, and last one is the real estate, which is our niche sector. So I'm very hopeful that with all these kind of initiatives like private sector or urban investment towards the private sector projects, and will not compromise either on the entity side or on the project side. Project should be well placed with all the approvals in line, including land availability. And at the same time, they will be backed by the good concessionary agreements, maybe HAM kind of projects. And the entity should be really strong to take our funds.
So what's the contribution, sir? What is the contribution of the private sector to the book now?
Presently, there is no performing asset or from the private side. Maybe it will start growing, maybe 3-4%, but there we have not set any target for the private sector.
All right, sir, I just want to push you a little bit. The AUM target of 3 lakh, by 2030, that means you'll have to grow in high teens, but you're talking about growing in mid-20s. So actually, the 3 lakh crore could actually come in closer than, that 2030, if I could just quiz you on that. And also, I missed the number for this year, disbursements, sanctions, what is the number likely to look like for FY26?
So I will start from the disbursement. Last year, we had disbursed around 40,000. This year, we are targeting around 50,000 crores. Similarly, on the sanction side, last year, we had achieved slightly more than 1 lakh, around 1.21, 1.23. This year, we are targeting 1.5 lakh crores. We had already achieved around 93,000 crores in the sanction pipelines. And we are hopeful to achieve around 1.5. And you are right that we need to revise and revisit our targets for 2030, but it is too early to comment on that because there are a lot of potential which we see, and including the Urban Challenge Fund. And just on the weekend, there was a urban conclave also, and we were discussing that how to lift our face of the cities, and we have to create around 50 global cities. So a lot of investment is required. We have to create around 50 global cities. So a lot of investment is required in the city side, and they will become the growth hub. And as we all know that they contribute about more than 60% of our GDP. So we are working on the cities. We are working on the infrastructure. Because cities are the face of our country, and to become the Viksit Bharat, around 80 lakh crores of the city investment is required. It means around 5 to 8 lakh crores of investment per year. So it's a huge investment in the cities, and we are planning our financials and the ratios so that we will be positioning in the best way.
Yeah. Final question, sir. Going back to the margin, where you're saying that you'll definitely be above 3%, 3.3, right, by the time the year ends. What is the borrowing mix looking like? Because your cost of funds has been coming down. Obviously, interest rate cuts here locally would have helped. What's the current mix like, and what are you thinking for the second half?
I think regarding income, definitely 3.3 is an achievable level, and a couple of projects we are on the advanced stage of resolution. So we were expecting the Q2 only, but nevertheless, we are on the right track, and the income will come from the resolutions as well. At the same time, we are expecting that the market is projecting that there will be another rate cut from the RBI, and we are very hopeful. So we had managing our treasury in such a way that the benefit of the rate cut will come as soon as possible. It is decided by the RBI. We are also planning ECBs in yen denominated, and we are also planning the GMTN. So since Fed has already started some melting down, but we are...
Conversation. Thank you very much for joining us, and really appreciate you being with us. Yeah, appreciate it. We'll take a quick commercial break here. We are back with the management of KPIT on the other side. They reported numbers and a large deal as well. Stay tuned. Coming up. Welcome back. As promised, we have the management of KPIT Technologies joining us now. So, muted set, but the company is guiding for much better second half. Some growth in third quarter, but much better growth in the fourth quarter, and a promising F527 as well. We have Mr. Kishore Patil joining us, Managing Director and CEO at KPIT Technologies. Thanks very much. Good morning, Prashant this side. I want to, of course, start by talking about this big strategic deal that you've announced, sir. $100 million plus is the TCV, and this is spread out over 3 years. Could you talk to us a little bit about how much this could add in terms of, top line, what it could mean for margins as well?
So, generally, as I said, our general growth comes through a regular increase in the business. But in some cases where there is a more strategic strategic engagement with a new client, typically then this kind of a deal can happen. And in this case, it is a multi-domain, multi-year kind of a thing where we are taking the full ownership of certain domains of the client, which include basically electrification. It includes a digital cockpit and some part of autonomy. And that's how it's this kind of domain we are taking. And generally, all these deals would not be any would not have any margin dilution. The ramp up would start from already during this quarter. We have already started the engagement, and it will keep on increasing. And over the next year, it will ramp up fully, and then next 2 years we'll get the highest returns. That's how it.
All right. Hi, sir. Good morning, and good to see you, and Mr. Patil. I was looking at your constant currency revenue growth. It was around 0.3% quarter on quarter. Caresoft acquisition, that would have contributed ballpark 2.5%, which means the organic growth actually was negative. Could you explain this to us? And in quarter 3, do you get back to a positive organic growth number?
Absolutely. I think what we have reported is minus 2.3% negative constant currency growth, while the reported growth is higher. But we have said that in the Q3, organic growth will be flattish to positive, and in Q4, there will be a meaningful growth. So absolutely, that's what we are seeing. And that is not only on the back of this deal, specific deal, but it is also back of overall recovery we see. We see the positive discussions with our client. We see a positive traction in certain segment. Europe seems very positive. We see India very positive. We see certain areas in terms of autonomy, digital cockpit very positive, and aftermarket diagnostics very positive. And based on some of these technologies and regions, we see this as a way going forward.
Okay, all right. And Caresoft for the year will contribute around 5% to the revenues?
Caresoft would be, roughly, I would say, less than that. But yes, because we have been doing some business with them also in the past. Okay. So looking at that, net addition would be anywhere between 3 to 4%, maybe around that. But yes, but I think it will be there will be a growth now going forward in all in Caresoft too.
All right, but you're sticking to second half of the year will be better than the first half of the year. And if that is the case, you said that organic growth, one quarter's down, next quarter's flattish, quarter 4 will be better. For the year, what kind of organic growth should we work with?
I would not give still a number. I will give you in the next quarter end. But it is very obvious that there is a clear growth which we have been showing on quarter to quarter. So I think from that perspective, we will continue to go this. I will be in a position to give you a number next quarter.
But sir, you can't give us a number, Mr. Patil. Morning, sir. But can you give us some idea about what makes you confident? Because the lack of organic growth is something that's been weighing on the market's mind as well. So what are the kind of deals that you're hoping to close? What are the sort of conversations you're having with what kind of clients that you think can get you back to growth?
I don't think I can say anything more than that because we have already $230 million of wins. But more importantly, one large deal, which we have said. We said that we have already started working on that. It will start ramping from the next quarter. It will ramp up next quarter and quarter after.
Okay. And sir, then what are the implications for margins? I mean, you're saying that growth will start coming back, organic growth. On the margin front, you're at 21%. So,
I think,
yeah.
Yeah. So basically two things. One is, as I think you would appreciate that with all the volatility, we are one of the company which maintained our margins. And the thing is, there are 2 to 3 reasons why we believe we will be in a position to continue to do this. First is we have moved a lot of our business to, I would say, higher-ended service, which is solutioning. And from last year, we have doubled the revenue. About 18% of our business is in solutioning. I think that gives us a little higher margin. And that is one part. The second thing is we are, of course, bringing efficiency in the operations with both of these kind of things. And we have not seen much pressure on the pricing.
Yeah.
So with all this, I think we will be in a position to maintain the margins.
Okay. That's an important... So just a question on the margin. That's an important point that you made, that you're not seeing pressure on pricing. And we're going to keep that in mind. But isn't there a wage hike? I'm not sure if you've already taken it in the third quarter. Are you planning to take one? So can you maintain 21% even in Q3, Q4?
I will give you 2 data points and I will come to your specific question. Our fixed price projects have gone up significantly. If you look at it, it is, and that means that we have a fixed price project. We are not looking at rates in terms of per person, but overall project and bringing the efficiency through AI and automation. All that we are doing, and that helps us to do that. Absolutely, we backed the increments. We will give some increments next quarter to many of the junior grades, and then from the quarter after to the senior grades. It's selective for the high performers, which we are giving. And that is backed in what the numbers we are giving and the margins.
Mr. Patil, just one question from my side. We had another IT services company, which essentially, I'm paraphrasing, but what they said is that because clients are focused so much on AI and boosting spending towards that, especially in the TMT sector, existing sort of business, perhaps, I mean, the focus, there's a limited amount of resource, so you're focusing on one and maybe at the margin at the expense of the other. I think you've also in your, release characterized that AI-led holistic solutions are eating away at the existing revenue base. There was some number that you specified. Could you just talk to us about this? I mean, what's the direction of travel? Is this likely to chip away at the existing revenue base?
Yeah, I think we have gone away from the model where we believe that there is a ODC and there are certain headcount, and that's what will continue to give us the revenue, and then you add certain headcount. I think the industry has moved away from that and is moving away significantly. So from our perspective, basically, the whole purpose for us is we expand and give a more holistic solution, not only what we have been doing, but much more than that, and take the full ownership of a project. And that we do along with the AI and other things. So our basic objective is to continue and maintain the revenue as far as possible, naturally what is relevant, but give a much higher productivity to the client. And that is what we are trying to do.
But it will not eat away from the existing base of revenue, all of this? No.
But in some existing, so what I'm saying is existing part of the revenue will get transformed. But of course, the growth will come from the places where I mentioned. But this will actually give us a higher margin and also some additional revenues. So I think it's a process which we are taking, because when the initial projects you take, it's different. But we believe actually on the back of this, there will be a larger revenues we can take from the client.
Okay. All right. And of course, as you said briefly, productivity gains as well, which perhaps come in. Yeah, thanks very much, Mr. Patil. Appreciate you joining us and good speaking with you. As you said, it's a transition phase. I think not just for you, but for many other companies is, all this is underway at this point in time. I'll just take a quick look at the market, which is down 80 points now. So I think we're at the day's low. Or at least, we're in the first 1 hour of trading and we're at the low point of the day so far. So 25,488 or so is where we find ourselves at. Jindal Stainless, Nigel, is the next management with us.
Well, that's right. Jindal Stainless, that's the next management on our radar. The company reported actually a good set of numbers. The EBITDA margins did show some kind of improvement. To discuss this, what went on in the past quarter, what's the way ahead, we're joined by Mr. Tarun Kulbe, the CEO and CFO at Jindal Stainless. Hi, sir. Good morning. Good to have you on the show, interested to hear how was the quarter and the way ahead. Let's focus first on volumes. I recall you telling us that volume growth should be in the vicinity of around 9 to 10%. At the half-year mark, you've done around 11.5%. So for the year, what kind of volume growth will you be looking at? And also touch upon exports. That market continues to be in a bit of a tizzy. I recall when you used to do more than 15% of your volumes were exports. Now, Europe is a key market for you in terms of the exports. They will be implementing carbon border adjustment mechanism. Will this lead to lower volumes out there?
Thanks, Nigel. So, so far as we as a company is concerned, you're right that we consider export market also important. And while predominantly we are a domestic focused company, so for us in the export, US and Europe, both are definitely one of the true major markets. And as we can see that uncertainty in the global market is there as of now. In fact, for the past some months, that uncertainty is constantly prevailing. Because geopolitically and globally, the policy changes, whether it is in US and also in Europe, so many changes constantly are happening and creating a lot of confusion in the market. Now, another aspect which you have touched, that is also true, that CBAM is going to get triggered from the month of January in Europe, and definitely that will also have certain impact. Beyond that, some quota and all also is in discussion. But the point is, there again, a bit of uncertainty because the Europe has to come out with clear guidelines, clear benchmarks, so confusion remains. Now, under the circumstances, while we are constantly watching these markets and dealing in the exports, wherever we see the kind of opportunity, but we remain focused on our domestic market, which is growing, which is constantly growing, and we are finding that opportunity. Looking at this, I will say that so far as our volume growth of 9 to 10%, whatever we have, the guidance what we are given, we are confident that we'll be meeting that. But export, we will be watching and trying to do more as a balancing number under the current situation. But overall volume growth, whatever guidance we have given, we are still maintaining that.
Okay, all right. Let's focus on the profitability then. You have done better EBITDA per ton than the guidance, right? Earlier, you were guiding for 19,000 to 21,000. What contributed to this? And do you want to upgrade your guidance on terms of EBITDA per ton? Also, tell us about the pricing trends internationally on stainless steel. Is it higher in quarter 3 in comparison to quarter 2?
Okay, so on one hand, I just talked about that the volume growth, what we have given. So all this volume growth, there are another aspect of that is that constantly we have been saying, even at the end of the last quarter call also, I had said that we as a company are constantly focusing on the value-added products and the products which are higher end applications and all that. And our subsidiaries are now performing much better, and we are more and more value-added product like cold roll we are able to sell into the market. So all these aspects, along with the increased volumes, is helping us in improving our EBITDA numbers. Obviously, means the cost is also they are helping us in keeping a bit in control, and we are able to hit our EBITDA numbers.
But do you want to upgrade it, sir, from 90 to 21,000? Do you think now it can be towards the higher end, 21,000 rupees per ton?
So, Nigel, at this stage, we would like to be watchful. As I said, that there is a continuous, so many uncertainties which are floating around. So, we would like to maintain our guidance, but and we believe that at this stage, we would like to maintain that.
Okay, 19 to 21,000 with 9 to 10% volume growth. Pricing, how is it internationally? I understand that prices have improved for stainless steel, correct?
So prices, again, on one hand, the prices are a factor of the raw material all along. We have been saying in the stainless steel. Okay. But yes, there are sentiments also which impact. So when these kind of uncertainties come, sometimes the pricing pressure also comes. Now in India also, I think you must be aware of the uncertainties due to different government decisions regarding TCO, allowing import, not import. That also impacts the pricing pressure. So, but at the same time, as I said, that for us, it is more of raw material, and then we try to see. So as of now, I'll say in India, there is a somewhat downtrend in the pricing we can see, but internationally also it impacts that way.
Okay, all right. In India, it's a little bit of a downtrend. I think some checks tell me that, globally prices have improved, but as of now, you're saying no big trend on that front. So we take that point on board. You briefly mentioned that VAP, that's the focus area. VAP as a percentage of sales, what is it? Where is it headed? And briefly, you could tell us defense. That's another focal point for you all. You all have mentioned that numerous times. It is a smaller part. Where is it headed? Currently, how much does it contribute?
So defense, Nigel, if I say that it is more of a niche product, and that is something we take more proud, because by doing that, we are able to demonstrate our even capability on the quality front and the quality standards. And this helps us to substitute many imports which are used, because in this defense, whatever material we give, it goes into the niche products of even missile launcher and submarine launcher, those kind of applications. And this also supports, of course, Atmanirbhar Bharat. So this is a beginning, I will say. So far as but we are building on it. We are building more of our capabilities. Yes. We have made some investments into the facilities which will help us in becoming more and more equipment, more and more grades, so that we can supply for these applications.
Final question then, sir, and I'm looking for numbers here. CAPEX guidance for the year, how much is it? If you could tell us how much have you spent, CAPEX? And net debt number has come down a little bit despite the CAPEX that's underway. Where is this number headed? CAPEX?
Okay, so CAPEX guidance, Nigel, we had given 2,700 crores for this FY 26. And out of that, 1,260 crores now in the H1 we have already done. So we are on course of that. And so far as our net debt is concerned, which was around 4,000 crores in March 25, we had given a guidance of 3,500 to 3,700 for this financial year. And at the end of H1, we are at around 3,650. So I think that is also, and our ratios, whether it is debt to equity and debt to EBITDA, they all are very much in control, one of the best in the industry.
Okay, all right, sir. It's a pleasure having you on the show. Thanks a lot for joining in. You've given us a brief idea, a sneak peek into how you've seen things panning out. The last quarter was good, actually, but we'll track you to some of these numbers. Thanks a lot for joining in.
Okay, that's Jindal Stainless. By the way, I think we'll put out important news updates from Delhi coming in on a separate matter, not the blast. But our colleagues in Delhi are reporting that I think Delhi is going to be implementing stage 3 of the Graded Response Action Plan. Because of the severity of the air conditions. It's actually in severe category. That's what Parikshit is telling us, that AQI is at 425. And with this, restrictions like stopping all non-essential construction or demolitions, all that gets put on hold. And there will be a restriction on usage of BS3 and BS4 vehicles as well, basically, with the old emission norms. So those are some of the emergency measures that come into place in Delhi. However, coming back to the market, just an eye back on these stocks. They continue to be in focus, both Bajaj Finance as well as Britannia. We'll get in Mangalam on Britannia in just a bit. Bajaj Finance is still down about 7%. We'll just get you some broker notes as well on Bajaj Finance on what people are saying. Morgan Stanley is saying that this dip is probably a good chance to add Bajaj Finance. Bernstein is one of the biggest bears on Bajaj Finance because of the asset quality issues. So more on it as we go along. But for the time being, let's get to our technical expert. Siddharth Rai Mangla of Stockbox Technologies is with us. Siddharth, give us your view on the market, any stock trades, and maybe a specific view on Bajaj Finance as well in terms of the technical levels now.
Yes, sure, Nifty. Hi, Surbhi, sorry. Good morning, and thank you for having me on the show. See, Surbhi, if we talk about Nifty, first of all, the data that has built up since opening today is not very encouraging for bulls, Surbhi. Just in the options data, if you look at the options data, more than 60 million new call option writing positions have been added just in these three important strike prices from 25,500 to 25,600. On the other side, in the puts, on the put side, there's the addition in put writing positions is less than 1/3 of this. So the resistances have become very, very strong now. And Nifty spending time around 25,500, playing up and down below around 25,500 will only weaken Nifty's momentum. And I do think that if Nifty goes down around 25,500 and 25,500 and spend some time below 25,500, we might be seeing a quick dip towards 25,350, 25,300 because all these put writing positions will start unwinding the positions. So the data is not looking very good for the index specifically.
Okay, Siddharth, stocks, what would you trade?
Yeah, sure, Prashant. I see. There are two stocks right now. I do think that it will be much better to keep a balanced approach. There are definitely some pockets where we are seeing some strength. Defense is one of them. So the first one is from the defense space. We have to buy this one. The stock's name is Bharat Electronics, BEL. See, today we saw an open low being made in this counter. Stock started running exactly from the point where it opened, and it tells us that the stock is in a very good momentum. BEL can be bought right now. The spot is trading around 423. You can buy it here. The stop loss will be 417, and the targets being first target 430, the second target around 435. The second stock is Indian Hotels. This one we have to short because the stock looks very weak. The structure is very weak. Just a couple of days ago, the reaction to its quarterly results was very bad. And post that, I'm seeing a continuation to that weak momentum because the stock is maintaining it around below 700 levels. That's a very big mark for the counter. So this weak momentum can continue. Indian Hotels we can short. Right now, the November futures are trading around 698, 699, somewhere around that region. So we can short them there. The stop loss will be 707, and our targets being the first target 680, the second target 675.
Okay, all right, Siddharth, thanks very much. Those are trades coming in from Siddharth this morning. Well, Britannia is taking a bit of a dive. Let's just revisit that story with Mangalam. Context and perspective, right? I mean, the background, I think, is important on this one. Mangalam, take it away.
Well, it's the abrupt nature of Varun Berry's exit which has the street a little worried. That he was likely to retire was pretty much on the cards ever since, the company announced Rakshit Hargave from Birla Opus as its CEO with effect from December 15th. The belief was that maybe Varun stays on as MD for a bit before, handing over the entire company as MD and CEO to Rakshit Hargave. And this was something which was pretty much expected by the street, especially at a time when the third and the fourth quarter were supposed to bring out better results for the company fundamentally as well. But what caught the street by surprise was the board's immediate acceptance of Varun Berry's resignation without any notice as well. So Varun Berry in his resignation letter did write that he is ready to serve notice and also, help with the transition. But the board's immediate acceptance of that has the street a little worried, largely because it comes, within less than a month of Rakshit Hargave actually coming in as CEO. So they've appointed an interim CEO in the form of N. Venkatraman, who's currently the CFO, and that uncertainty is something that the street does not like, and which is why we are seeing the stock take a sharp nosedive.
Okay, all right, Mangalam, thanks very much. 5% lower as we speak. We take a break. On the other side, Manisha joins in with what's the latest as far as the commodity action is concerned. Stay tuned.
Welcome back. So the equity market is having a bit of a dull morning, 60 points lower on the Nifty. But let's find out what's happening in commodities. Earlier, Manisha told us that obviously gold is back to its glittering ways. Let's see what she's tracking now. Manisha?
Oh, yes, I'm looking at precious metals because this is a segment that seems to be coming out from its consolidation period, which we did see last almost like a month there. But look at the gold prices, and we've seen 2% of gains in the overnight market. All-time high has been 43.80, and we are trading at around 41.50 at this point in time. When the correction did come after hitting those all-time highs, we did see gold prices go down to 39.25 on the lower side as well, but trading not just above 4,000, but above 4,100 as well. Same is the case with silver, 4% of gains in the overnight market. All-time high has been 54.5. We've seen prices decline below 48 as well, but we are trading above 50.5 at this point in time. So a very strong comeback from the kind of lows that we have seen in gold and silver both. I mean, remember, those were overheated levels, and some profit taking is something that the markets were anticipating, and there's a smart rebound from there on. The support also comes in from the fact that there's a growing expectation now of a Fed rate cut in the month of December. This is on the back of weak economic data that we have seen come in from US. So the US consumer sentiment is at the second lowest reading on record. That tells you that the rate cut perhaps is an important thing. Apart from that, the labor market also shows weakening signals. The US jobs layoff surge to the highest in 20 years when that data came in the previous week. So that has been quite supportive as well. And because of this weak data, you have the US dollar index, which has declined yet again. We did see dollar index go to 100 and plus, but that has not been the case in last couple of trading sessions therein. And then apart from that, this has been the ever longest US government shutdown in history. While there is consensus that we would see the US government reopen on the 1st of Jan, but until then, the kind of missing of data and the impact that it has had on spending and budget is something that the street is taking cognizance of. And then this is the most important one. The global central banks have bought 634 tons of gold between Jan and September. The last 3 months perhaps could see another 150 to 200 tons. Remember, for last 3 years, the gold buying by central banks has been up to the north of 1,000 tons every year. And that perhaps is exactly what you could be looking at as a number this year as well. Chinese central bank buying has been constant for the last 12 months, and that clearly has been very, very supportive. This is after this recent jump is what we've done in sense of gold and silver prices in this year until now. So gold is up 57% and silver is gained up by 76% in this year till time. But I want to focus slightly more on gold and the expectations for 2026 now. Most of the global banks have started to come out with their forecast for the next year. Morgan Stanley has talked about 4,500 by mid-2026, and then they will take a call on how the second half looks like. Wells Fargo talks about 4,700 by the end of 2026. 4,700 is by March 2026. A possibility is what UBS has come out in sense of a report. But the most common and agreed upon price really is $5,000 an ounce by the end of 2026. That is the view coming in from JP Morgan, also by HSBC. JP Morgan also says, by the way, that in next 3 years, they expect the gold prices to consolidate, keep moving higher, and $6,000 an ounce is an expectation going forward as well. But then take a look at Bank of America, Society General, Goldman Sachs. They're all talking about 5,000 to 5,055 of a level by the end of next year. So clearly, higher highs is what the markets are anticipating. Till time, we've almost done $4,400 an ounce. And from these kind of levels, another $600, $700 of a gain is what you could perhaps see by the end of next year as well.
Okay. All right, Manisha, thanks very much. Interesting stuff there. Well, we'll take a quick commercial break here. Coming up on the other side is our special segment. It's the economy. Lata discusses the sharp rise in aluminum and copper prices with Gregory Shearer of JP Morgan. Stay tuned. That conversation is coming up next.
Welcome to It's the Economy. Actually, we are continuing where Manisha left off. Today, we are discussing metals. Copper and aluminium prices have gone through the roof over the past 6 months, from lows of about $8,700 per ton for copper in April. Copper prices have jumped nearly 23% to over $10,800 today, while aluminium prices too have risen by about 25% from their April lows. As a result, metal stocks like Nalco, Hindalco, Tata Steel and JSW Steel as well have been big outperformers on a year-to-date basis. To understand where metal and steel prices are headed, we have with us Gregory Scherer, the head of base and precious metals research at JP Morgan. He's joining us all the way from London. So, Gregory, thank you very, very much indeed for joining us. Let me start first with aluminium prices, because there are significant Indian listed companies in this space. What's your guess? Are we going to continue to see aluminium prices ramped up in 2026 as well?
Yeah, so from our perspective, we see aluminum prices heading towards 3,000 by the first quarter of 26 and remaining quite elevated through the first half of 26. We're in a market here that in the very near term remains very balanced with supply risks. We have outages in Iceland. We have potential for significant capacity in Mozambique to go offline from March 2026. And Chinese capacity is still capped and running up against their 45 million ton cap. On top of that, and I'm sure we'll get to this, we remain quite bullish on copper and think that there's a magnetism higher from copper prices, which continue to pull aluminum up towards around 3,000 in the very near term as we look to the first half of 26. Now, broader speaking, we do think that Indonesian supply growth, as we look to 26, 27 and beyond, is very much the real deal. We have something approaching almost 1.5 million tons of additional Indonesian supply growth over the next 2 years. And that will begin to sort of undercut the market, but we don't think that's a story until later into 2026. And particularly, we think at prices close to 3,000, those Indonesian producers are going to be very well incentivized to bring on supply, but in the very near term, still looking like a very sort of tight balanced market, with particularly copper tipping the scale and pushing aluminum prices higher as well.
Okay, so aluminium higher because of copper. Actually, I did read your report, and I ought to have started with copper. It's just that there are more listed aluminium stocks and hence more viewer interest. But let me come to copper itself. What is the sense? Are you getting a sense that copper prices are also headed even higher?
Yeah, we actually think copper prices on the LME are headed towards 12,000 in the first quarter of 2026. What you see in copper is a market that we see two important dynamics. The first one being we're in a very dislocated inventory environment. The U.S. has over-imported by over 600,000 metric tons. But at the moment, because of the potential for there to be a refined copper tariff on imports into the U.S. later in 26 or in 27, U.S. COMEX prices continue to stay above LME prices. And that has two important key dynamics. A, all of that copper that's been shipped to the U.S. is essentially locked in the U.S. until you see prices change. And B, the U.S. continues to take near normalized around 60 KMT a month imports despite having significant levels. So what that's really done is drained inventory from the rest of the world, and Asia in particular. Then you enter significant disruptions, which has basically led to our forecast that we see in the fourth quarter already a significant refined deficit emerging. And then over the course of 2026, given the outages we see at Grasberg in particular, about a 300,000 metric ton deficit. So ultimately, what we really see is that this is quite a very bullish near-term setup. The Asian refined copper market, which is, feeling stress from both the US as well as Europe, getting very tight, and that the front of the curve, and particularly LME prices, we think are headed towards around 12,000 in early 2026, have much higher to go. The big risk right now, Chinese demand is a bit soft every time we test 11,000, but we ultimately think, look, these supply disruptions are not going away. And from that perspective, we do embed a bit of a weaker Chinese demand environment, but ultimately see us going towards a place where China is essentially going to have to almost stop into this, and that really much tighter dynamic of a market as we look to 2026 is quite influential to driving prices higher for copper.
Okay, so $12,000 in copper. Well, let me come to steel. We saw major disinflation in steel, with Indian steel makers actually demanding anti-dumping duty on steel coming into India. Any guesses on how Asian steel prices go from here on? Are we likely to continue to see steel disinflation in Asia?
Yeah, so from an India perspective as well, our equity analysts who are metals and mining equity analysts who cover the Indian steel market do still see through the March end quarter about a 3,000 rupee per ton increase in Indian steel HRC prices. Not only are they expecting post-monsoon to see a recovery on the demand side in terms of construction, we're also expecting a bit of a continued extension on the dynamics you were talking about, anti-dumping. The big risk here is that we are seeing still oversupplied levels coming out of China. That is, in our view, not going to drive, a surge higher in steel prices. But ultimately, they're also not really embedding any significant sea change in terms of Chinese stimulus, which could change their sort of domestic S&D dynamic. And that remains one of the most bullish risks out there in terms of Asian steel prices.
Okay. Well, this anti-involution policy of the Chinese government, capping of steel output, wouldn't that make for, some definite level of bullishness?
Yeah, ultimately, it down the road it does, but there's still a decent amount of work to be done on the oversupply. So it's setting the groundwork, and this has been something that's kind of been a give and take throughout, many different, a few years here now. But as we look forward, it sets the groundwork, but we're still working through a bit of some oversupply in China.
Okay. Well, now let me come to the, reserving the best for the last, gold and silver. We did see a dip in gold prices, below the $4,000 mark, but it's come back strongly. What's the guess for gold up to the end of the year and early next year, early 2026?
For gold, in the very near term, what we've seen is we saw a pretty exceptional level of demand in the third quarter of 25. Just to put it into context, if we think notionally, it was almost $105 billion of demand across both central banks as well as investors, so inclusive ETFs, retail, bar and coin, as well as futures. To put that in context, that's almost 80% higher than what we've seen in the previous 4 quarters. So the market's digesting that now. We had a lot of ETF flows as prices ran up towards and above 4,000. What we think is that this correction is ultimately quite healthy, right? We need to digest that level of inflow. As we look to 2026, nothing has structurally changed in our view. We remain very bullish. We have a year-end 26 target of just a touch over $5,000 per ounce. What that looks like is we think, in the very near term, you're in sort of a level between 42, 43, and then you begin to move higher as we go into year end and early 2026. And what you do actually see is some pretty strong typical seasonality around year end and into the first few days of January. And we do think that could be kind of a catalyst here. So, to recap, near term, digesting some pretty impressive inflows on the demand side, particularly in terms of ETF growth. As we look to next year, still expecting central banks to be buying something around 760 tons. On top of that, expecting investors on ETFs to be adding something around 360 tons. When we add all that together, still very much a bullish trajectory, and expecting prices are, next stop is towards $5,000 per ounce.
Oh my God, $5,000. Well, can you just give me, for 2026, the average for gold and the approximate range?
So in terms of the average, what we're seeing is something that comes in roughly around 4,600 to 4,700 on average. And then from a silver perspective, ultimately, we do think that what you saw was a bit of an illiquid move higher with very exceptional Indian demand pre-Diwali, ETFs creating, and this worries about Section 232 critical minerals keeping metal in New York. As we look towards 2026, we do still think you're headed towards a range that's something around 55, 56 by the end of 2026, but a little bit more orderly and following gold higher as we go deeper to next year.
Would you say silver will follow the same trajectory?
Yeah, we think ultimately that how we kind of think about that is in the gold to silver ratio, which we ultimately think is at fair value between an 85 to 90 ratio range. We dipped down towards 80. We think that was a bit of silver outperformance given some of the liquidity issues that we saw. Ultimately, we do think we're probably past that peak, really significantly backwardated London market, restoring a bit of free float tons. And from that perspective, see it being a little bit more orderly of an increase as we look to 26.
Okay. All right. Let me end with a question that's designed more for your economists. For a better part of 2025, economists were telling us that Asia will be ridden with disinflation. But with this bullishness in some metal commodity prices, will Asian disinflation go away? It won't be that severe. Will Asia see any bit of inflation?
So yeah, we have been seeing, and our economists have been tracking disinflation across Asia, particularly driven by Chinese exports. We are beginning, it's quite interesting because they've been tracking recently a bit of a turn in Asian inflation. That's mainly so far been driven by food price inflation. Where we're actually still seeing trends of disinflation and that kind of continuing to move forward is in EM Africa, as well as sort of EM Edge Europe, where actually the disinflation that Asia had been feeling for most of this year is now kind of moving a little bit further abroad. We do think that there will be this sort of dynamic higher from a raw material price, particularly on the metal side. Yet we're still thinking, our oil strategists are still looking for prices sort of in the upper 50s to lower 60s for Brent. So we do think that is still relatively constrained, which keeps things relatively orderly.
Okay. Yes, there is, of course. Crude is heading lower, or at least not able to break even $65. Thank you very much, Gregory. It was a pleasure having you with us and for a 360-degree perspective on all metals. Thanks a lot for joining us. We have to wrap up on Bazaar on that note. Chartbusters coming.